So today I'm going to talk about one of the investment trusts that we run at Aberdeen, which is the Aberdeen UK Smaller Companies Growth Trust, which I'm the manager of. And this is, as an investment trust, it's a closed-end vehicle which is listed on the London Stock Exchange. So I'm sure many of you in the audience are well aware of investment trusts as a structure, but just for any newcomers to the space, what are the benefits for you of investment trusts? So one of the benefits for you is actually a benefit for me, which is investment trusts create a fixed capital. And that means that me as a fund manager, an investor, is able to take a longer term time horizon in terms of looking at those investments. It also means that I don't need to hold quite as much cash as I might do in an open-ended vehicle, which is subject to potential outflows. So it really lets me be fully invested in the asset class. A benefit for you is that if you buy our investment trust, then you are a shareholder. You get a say in what happens in this investment trust, you get to vote, you get to attend our AGM. And importantly, we also have a board of directors for the investment trust, and they are there to act on your behalf in terms of representing your best interests. Investment trusts also can employ gearing, and that means that actually you can get a higher return over the long term if we see rising markets, because you've got incremental gearing into that. And we're also looking to provide for you a consistent income stream through the dividends that you receive as shareholders. And we're able to use reserves as well to protect that in tougher environments. And lastly, there's a discount opportunity for shareholders in investment trusts. And this is really important at the moment, as I'll come on to later in my presentation. But if we can see a narrowing of that discount of what the investment trust trades to relative to the NAV, the value of its underlying holdings, that can also generate an incrementally positive return for you over the long term. What are the risks for you, though, of holding investment trusts? So one would be in that declining market, gearing is not a positive. And the other thing would be that discounts can widen out as well. However, over the last 10 years, in over 70+% of sectors, closed-end vehicles have outperformed their open-ended equivalents. So that's why we think investment trusts are a really good structure. And what about UK smaller companies? So that's the asset class that my investment trust, the UK Smaller Companies Growth Trust, invests in. And what is that? So when we talk about UK smaller companies, what do we mean? So if I take the market cap of all of the UK listed market, we're looking at really the bottom 10% of that by market cap is what we look at for smaller companies. Now, that might seem quite small, but importantly, that's actually the biggest percentage by far of the investment opportunities that we have as UK investors. So that smaller cap space represents 86%, so around 1,000 companies in the UK. If you're investing in the large cap space, for instance, in the UK, actually, your investment opportunities are quite small in terms of the number of companies. So that's what makes running a UK smaller companies portfolio just so attractive to me as an investor, is I have so many different companies I can invest in. And for our trust, we tend to look at companies which have a market cap of around 200 million or 250 million and above. So we're not playing in that, what we would call micro cap space below that. And what's attractive about smaller companies is that if you look over the long term, smaller companies have generally outperformed their larger company peers by quite a significant way. And we would always encourage people when they're looking at smaller companies investing to take a longer term time horizon. So we would say to you as shareholders, think about 5 years or beyond in terms of how long you would want to hold holding within the UK smaller companies space. So what type of companies do I hold in my portfolio? So when I talk about UK smaller companies, importantly, I'm not just talking about the UK economy. So for instance, just over half of the revenue of all the companies that I invest in the portfolio is actually generated overseas. Now, that doesn't mean that all the revenue generated in the UK is not attractive. It's fantastic. So if I look here, these are some of the dominant UK leaders of UK-only businesses that I invest in. And I'm sure some of you will know these businesses. Probably most of you have heard of AJ Bell before. You might not have heard of Cranswick, but I take a good guess that practically everyone in this room has consumed a Cranswick product at some point. So Cranswick is a food producer of pork and chicken products, which you will buy from all your favorite supermarkets. Things like Telecom Plus, for instance, you might not know that name, but you might know Utility Warehouse, and they might be the provider through which you buy your home services through. So we have lots of great UK businesses, and as I'll come on to, even though headlines around the UK economy have not been that buoyant in recent years, actually these UK small, medium cap companies have been great performers and really resilient. Now, we also have some global leaders who are listed in the UK, but are leaders globally in what they do. So for instance, Coats is a manufacturer of thread, which goes into a lot of the clothing, footwear, particularly around athleisure and things that you might well purchase. Bloomsbury, I'm sure everyone here has hopefully heard of Harry Potter. Bloomsbury are a publisher, and Harry Potter was one of their biggest franchises that they were the publisher for. The current top favorite for everyone that's growing significantly quickly is called Sarah J. Maas as the author. Ashtead Technology is an equipment rental business for subsea equipment for oil and gas and renewables. So you can get exposure into lots of interesting global growth themes through these UK-listed companies. And looking as well at growth by expanding internationally. And this is one of the things I love about these companies, is we're looking for companies where they can elongate their growth trajectory. And that's often by moving into new, it might be a segment, it might be a new end market, but often it's also a new geography. So if I look at Hilton Food, for instance, another food producer we own, operates in many, many countries globally. As well, Breeden, which is an aggregates business. They've made a big acquisition in the US, and that's another really good growth angle for them. Premier Foods, another one that you might not have heard of, but you definitely have your cupboards at home full of Premier Food products. So this is the way that we think, look, there's been a lot of negativity about the UK economy, but don't let that cloud your view and your judgment on why UK smaller companies might be an attractive asset class for you to invest in. And just to highlight that, we've got some pretty lackluster UK economic growth forecasts, don't we? And they're in the headlines weekly. So we're talking about, we're hopeful of getting 1% sort of economic growth in the UK. But this portfolio of UK-listed smaller companies that I invest in is forecast to grow at 16% earnings growth this year. So still, by being portfolio managers and really focusing on stock selection, we can find some really great sustainable growth long-term investments. So what's interesting, and hopefully for you, about our growth trust? So one thing I'd just like to highlight is the broader team that I'm part of. So I run this growth trust along with my colleague Amanda Yeaman. But this is our smaller companies team who are based all together up in Edinburgh. And what's important about this is that my colleagues run European smaller companies and global smaller companies funds. So we get really interesting insights from them about the companies that they're seeing, what are happening in their economies. Perhaps some of our companies will have peers or people in their supply chain that my colleagues will know. So we have a really good insight to that broader global smaller companies space. And how do we invest? So we focus as a team on quality, growth, and momentum. So that is what you would have exposure to in terms of style dynamics if you bought our growth trust. And what do we mean by that? So firstly, when we think about quality businesses, we want to buy companies who we can rely on, who are resilient, who can have sustained growth, who have lots of different drivers, who have great management teams. And importantly, by having that quality focus, that helps to protect your assets in tougher economic environments. And we've seen that in recent years. If we think back to COVID, we think back to a recession, all these things. Because we focused on quality companies, we continue to see earnings growth. We also continue to see dividend growth, which was passed on to you as shareholders of this investment trust through the dividend growth that we've delivered. We focus on growth companies, but importantly, it's sustained growth. So these are companies that we want to pick who we think can drive growth predominantly through organic growth, but also they might do bolt-on acquisitions of other companies. And we're focused on companies who can do that year after year after year after year. We look to really back our best ideas and run our winners. So when a company is doing well, it's thriving, it's growing faster, it's getting earnings upgrades, we will hold on to that investment and we will continue to run that. We also use a stock screening tool, which I'll touch on a little bit, and that really helps us to focus down on, I talked about this 1,000 company opportunity. Which ones of those are actually most suitable for our investment process? So that really helps us screen that down. We look for long-term investments, so we tend to think about what's going to happen to this company over the next 3 to 5 years. Often that elongates because actually they expand into adjacencies, they expand into new end markets. So many of these companies we might have held for 10 years in the portfolio. We meet all of our company management teams. That's really important. So I meet them all at least twice a year. Many of them I might meet 4 times in a year. And also, we're always conscious of valuation. So for our companies, what is being priced into the value of this business, and do we think that's sensible? Briefly, just on the matrix. So this is our stock screening tool that I talked about. So I won't go into too much detail here, but what I'll just say is that this helps us to screen down onto what it thinks is quality, growth, and momentum businesses. And you can see in the chart here, the best scoring, so the first and second quintile of these businesses have outperformed strongly over the long term. So it's a really useful tool for us to have. What else it does is it removes a lot of the behavioral biases that you can get in investment management. So this tool doesn't know these companies. It doesn't know what they do. It's never met their management team. So by using it, it really helps to not let me as an investment manager have those behavioral biases. So just looking briefly at the sort of top 10 holdings. So some of these names were obviously on the slide earlier. So hopefully you're aware of some of these companies. You might come across them. But the thing I would highlight here is it's a really diverse mix of businesses. They do all sorts of things in all sorts of sectors. So as an end investor, that gives you good diversification. Importantly as well, it's looking at these are businesses which are growing their earnings. You see the recent direction of earnings. This is what I'm looking for. I'm looking for companies who, when they report, when they speak to the stock market, they're doing better than people expected. They're meeting and beating expectations, and that's what we're looking for. And in terms of the percentage of the portfolio, so we tend to hold around 45 to 50 stocks on average in the portfolio. So that means that the highest positions tend to be around 4%. It really allows us to back our best ideas, but also have enough diversification to control those risk exposures. So just looking at what we've seen in the market. So I said earlier, look, it hasn't been an easy time in terms of economic growth in recent years. And we've seen, if we look at the UK smaller companies universe, for instance, which is the bottom line here, the lighter blue line, earnings have been tougher. They haven't been as resilient. We've seen some earnings downgrades across the market. It's been tough out there. But because we focus on quality growth businesses, our portfolio, which is the navy line on the top, has continued to deliver sustained, resilient, and growing earnings. And that's really important. And if I just pull out, I talked about Cranswick as a product area before. This is the type of great quality growth business that you can invest in UK small cap. So the management team have over 100 years of experience together. This company has delivered 36 years of dividend growth. It's growing at 20% earnings CAGR over the years. And it's really got a very strong cash generation and balance sheet. So just looking what have we delivered over the long term. So you can see here, this is the performance of our UK smaller company strategy over the long term relative to the peer set. So we have delivered significant long-term outperformance, and we look to continue to try and achieve that for our end shareholders. So lastly, just why is now an interesting opportunity, we think, for this trust? Trends don't last forever. So if we look at the things that have driven markets over years, quite often the best trends in one decade are actually significant underperformers in the following decade. And the thing that we've seen most recently is this US stocks. So US stocks have been great performers recently. 50% of global equity returns last year were generated by just 8 companies. I'm not sure we will ever see that again. And what we see now is that if you look at US stocks, history would suggest that from the starting valuation they're on now, they'll generate 0% return over the next decade. And investors are really starting to look at that. So far this year, we've seen a lot of flows out of the US stock market and actually into areas elsewhere, like Europe, like Asia, like the UK is starting to come. And we see that through what the end investors have generated in terms of returns this year as well. So if you look here, the green line here is the MSCI World. So let's say you have exposure to global equities, to world equities. That used to be actually quite a broad, diverse holding. But now, that's probably 75% in US stocks. And within that, it's really as well dominated by a handful of stocks. So what that's meant for you as end investors is that you might think you have exposure to global equities, but your returns are really dominated by US holdings now, and particularly those handfuls of stocks. So global equities have actually generated 0% return this year. And that's been driven by the underperformance in the pink that we've seen from the US market. So while we have seen good returns starting off this year from areas like Europe, from UK, from Japan, actually most investors now have exposure to global equities and don't really have exposure to those type of returns. So that's where we're really starting to see that shift out of global equities and US equities. What could be positive for the UK? What could be a catalyst? So we are definitely seeing more of interest in UK equities. I think this has been true for the last year or so, but it's really starting to gain momentum. And one thing as well is we've seen much more government awareness about this. So whether we do see pension reform or not waits to be seen, but there's certainly a lot of push towards that, where the government are talking about trying to push that big capital we have in the UK of pension holdings that have really underallocated to the UK in recent years. They have very small holdings. Whether they are going to start to be suggested and pushed and perhaps mandated towards holding more domestic equities. That would be a big positive, because we would see big flows into UK space, and that would be a real positive return generation, I believe. Also, we've just got a big discount in UK smaller companies at the moment. So I did some work looking at what valuation are you paying for these different asset classes compared to their 10-year average. You can see here the big blue, light blue line for UK. So UK smaller companies is the cheapest asset class globally relative to its last 10-year history. And you can see here, I mean, the US large cap is really one of the standouts in terms of you're paying a lot more for that asset class than you've paid before. So we think there's a real valuation opportunity there. And that comes back to the triple discount opportunity that you have in this investment trust. So firstly, the UK looks cheap versus other geographies. Secondly, smaller companies look cheap versus their large cap peers. And then thirdly, our portfolio trades at a 10% discount to NAV. So that's where if we can try and close that discount, that's an incremental return for shareholders. So our board are very aware of this, and we've been doing a very active buyback program as well to try and support that. But what that also means for you as shareholders of this trust is that if you buy exposure to these holdings through our investment trust, you're buying them at a 10% discount than what you could do if you went and bought all of those holdings individually. So hopefully that's given you a good summary and introduction to our investment trust and UK smaller companies as an asset class overall. I think I'm probably out of time, but I'm going to go downstairs. We are at stand M4, downstairs in the corner. So please, I'm happy to answer any questions, have a discussion about the topic downstairs.
Thank you, Abby.